Welcome to the Nepsis Capital Management quarterly update for the second quarter 2017. My name is Mark Pearson. Thank you for taking the time to listen to this update. As you may or may not know, there is also going to be a hard copy version of the update we encourage you to take a look at. First, let me begin by thanking you for the opportunity to be the steward of your resources and the opportunity to provide you with investment clarity as it pertains to your investments and why you invest the way you do here at Nepsis Capital. We are now halfway through the year, new Trump administration. Despite what many people have thought, markets continue to move to all-time highs. Of course, please remember, as I often say, with Nepsis, you don't invest in the stock market. You don't invest in the markets. You invest in businesses, in great businesses, and continually invest in those businesses over time, utilizing what we call strategic cost averaging, the ability to continually invest in those great businesses over time. Of course, the economies expand and contract. Corrections do happen. It's been a long time since we've seen any sort of correction. It's going to happen. I don't know when, but when it does, you can be rest assured that we will be continually looking over the portfolios to utilize our 4 sell disciplines, which you can see on our website at nepsiscapital.com, and continually looking to increase the quality of the portfolio. That said, 6 months into the new year, new administration, and to be blunt with you, we continue to be extremely bullish in terms of the economy and investing, certainly through the rest of 2017 and into 2018. Of course, we have tools that we use to gauge the economy and look at what's happening with valuations in companies and in the overall stock market so that we can be better educated to provide you with insights and manage portfolios accordingly. We're very happy with the first half of the year's performance, particularly in our more conservative portfolios. In our more aggressive portfolios, we're very happy. Of course, we have a large position in a company called EcoArc. Several people have been asking about that. We did a write-up in that in our last quarterly. I'm going to do another write-up in this quarterly, and we'll also address that in this video update as well. Now, why do we think markets and economy is going to continue to improve? Number one, there is still more cash sitting on the sidelines than there was at the bottom of the stock market in March of 2009. Number two, according to the American Association of Individual Investors, who track bullish and bearish sentiment in the markets by investors, for over 25 of the last 26 weeks, the bullish sentiment has been below the historical average. Long-term bull markets, long-term rising markets die on euphoria. They rise on skepticism. And boy, is there more skepticism out there than we can shake a stick at. Of course, everybody's trying to prognosticate and postulate when the next correction is going to happen, but frankly, who knows? And frankly, if you're a longer-term investor, who cares? What is most important is that your portfolio is allocated appropriately for your long-term goals. Notice I said allocated, not diversified. Diversification is a function of diversifying within a single asset class. Asset allocation is diversification along with asset allocating or owning multiple asset classes to give not only diversification but asset allocation. Why is that important? Because during corrections, with the way Nepsis Capital manages portfolios, we have complete flexibility to take cash out in the best, most logical place for you to accomplish your income needs if you are taking money out on a regular basis. We have been talking about smart investing lately. You may or may not know at nepsiscapital.com. We have a new website up. We're very excited about it. We talk a lot about SMART. What is smart investing with clarity? We really believe fundamentally, folks, at the end of the day, when the rubber meets the road, when it's most important, that the ability to know what you own and why you own it is a foundational component to long-term successful investing. We refer to the 4 keys to successful investing: the investment philosophy, strategy, flexibility, and transparency. And within that, the ability to know what you own and why you own it, when you want to know that, enables Nepsis to lead, guide, and provide insights and direction to you to enhance your ability to invest with success. SMART is an acronym for SMA, Separately Managed Account, along with the art of investing. Many people talk these days about buying cheap index funds and buying low cost ETFs. Here at Nepsis, we are not a McDonald's. We are not interested in the lowest cost product and lowest cost service. We are interested in high quality product, high quality service. Fortunately for you, we don't sell a product, we sell a process. The management of your portfolio is very strategic and very specific. And the SMA component, the separately managed account, is what allows you to have complete independence from other money. Your money's not commingled with anyone else's money, it's your money. And it gives us ultimate flexibility to manage it according to your goals and your objectives. Now, as I mentioned, we're 6 months into the year. We're very pleased with portfolio performances. Of course, we do have one drag, and that's EcoArc. And EcoArc is a position that, if you don't know, I have been involved with since the company was private 5 to 6 years ago. Was involved as they uplisted to the stock market and have been intricately involved in the long-term goals and planning for that company. We do own more of that company than any of our other positions, and that is because the amount of clarity that I have in what's happening in that company makes me very excited about this company. This company, by the way, owns a technology called Zest. It is a cloud-based software company and data warehousing company that provides supply chain management end-to-end from the farm field all the way to the retailer floor. There is no company in the world that is doing this. There is no company doing it at this level. And Fresh, you may have been hearing a lot about Fresh, a la Amazon buying Whole Foods, Blue Apron going public. Fresh is a very, very hot area in Wall Street, and Zest owns the technology that allows you to track fresh from the farm to the floor. They are now beginning to gain traction. We believe this is a game-changing technology. I was in San Jose last week. I met with the CEO of Zest, Peter Mehring, had a great meeting. Got to see more detail on the software and the direction of the company. And despite the fact that the stock is down this year, we believe that longer term it's going to do well. And like we do with any great business we own, we continue to buy it on sale. That's how you're successful in long-term investing. So we believe there is tremendous opportunity for Zest. We believe that Zest, which is owned by EcoArc, is going to have a great run in Wall Street as it begins to learn the power of their technology and what they can do. Obviously, I can go into a lot more detail, but because of the fact that we own as much as we do, you can obviously see my confidence. Secondly, people ask, well, you've got so much in one company. Well, if the company goes down by 50%, folks, it'll have a 4 to 5% impact, maybe 3% impact, depending on your portfolio out there. In the meantime, the rest of the positions in the portfolio are doing very well. And we really believe at the end of the day, the risk we're taking to get the return potential in EcoArc may be the best that I've ever experienced in this business. Now, I could be wrong. Investments go bad, things happen. But I am intricately involved in this company, speaking with management on a weekly basis, learning about the technology, talking with them about strategy, and I believe that longer term this is going to be a great investment for our clients to own. Now, why are portfolios doing so well despite EcoArc? Well, number one, financials. Number two, technology. Now, there's been a lot of talk on Wall Street about owning the indexes, own the S&P 500 and FANG stocks. Facebook, Apple, Amazon, FANG, what's the N? Netflix. You can see I don't invest in these companies, can't you? And Google. These 4 companies I'm not interested in investing in, but the S&P 500 is a market cap weighted index, meaning the larger the market capitalization of the company, the more impact it has on the index. Facebook, Amazon, Netflix, those 3 companies, along with a couple other, trade at substantial valuations. They are very, very expensive stocks. And when we do analysis on portfolios that are not with Nepsis, investors don't realize the risk associated in their portfolios with owning those stocks. They just keep making the index go higher. For those of you who are old enough, you may remember 1999 into 2000, a very similar setup with those stocks. Now, the market is not overvalued like it was in 1999, in fact, not even close. So we believe the economy is going to continue to expand. We believe that the companies we own are doing well. Our financial Citigroup and Bank of America had great numbers. Baidu, on the top of my mind right now, had great numbers last week. And here's a great example of investing in a company over time and continuing to buy it on sale. From 2014 until about 3 weeks ago, that stock basically was flat and trading in a range. Today, a month later, we're almost at an all-time high. Stick to process, stick to successful investing. It will allow you to be successful. Now, why do we think the markets are going to continue to go higher? Not only is there a lot of cash and the economy continues to expand, but you also have a lot of money in fixed income that's not making any money. As we have said to you for years, you are not going to make any money in bonds except for the coupon. And the coupon is nice if you want to get 1.5%, 2% or 0.5% on your money. But the potential to make money in bonds is not anything like it used to be, folks, in the 80s and 90s and into the 2000s. It's just not. And that's because of the way bonds are structured. The only reason you should think about owning bonds today is what we refer to as a beta mitigation. What that means is owning bonds reduces volatility in the portfolio. Of course, volatility also creates opportunities to take advantage of great businesses on sale. One of the reasons why our more conservative portfolios have done so well is we really don't own much bonds. And we have owned other income-producing type investments like dividend stocks, real estate investment trusts, utilities, and the such. And they continue to do well while we sprinkle in a little bit of growth in the portfolio so that those conservative portfolios can keep up with inflation. So overall, we maintain extreme excitement over what's happening with the investments, what's happening within the markets. We're very confident based on this last quarter's earnings we just saw. Most of our companies came in very well. There's always going to be a couple that don't, but they've had very little in the overall performance of the portfolios. So we're very excited. And to be blunt with you, it's not the individual stocks in the portfolio, folks, that makes the success. It is the process. It is the process that is used to decide the businesses that are owned and how you own them and how you manage them in the process. Not one company in that portfolio should make or break the portfolio. And every specific piece that is owned in every portfolio is owned for a very specific strategic reason. The power of smart investing with clarity, the power of the science, the numbers, and the art, the makeup of the portfolio, the ability to strategic cost average, the ability to pick and choose where to sell when selling is needed, the ability to tax manage the portfolio. These all come from a function of an SMA, separately managed account. We call that smart investing with clarity. A couple more final points before we're done here. Number one, as I mentioned before, please check out our radio show, Investing for Success. You can get it on iHeartRadio. If you're not here in Minneapolis, just search out Investing for Success with Mark Pearson. I do a daily radio show from 4 o'clock to 5 o'clock Central, where I have the ability to communicate with our clients, communicate with the investment public about the process of investing, about what's happening within the markets, about ideas of how to invest, and other various associated investment topics. I would encourage you to do that. We are all also In the near term, going to be launching a podcast site, so we're very excited about that. We'll be doing more podcasting as well as video podcasting so that you can get a little closer with the person who is ultimately responsible for the investment decisions in your portfolios. Of course, we have a great, very well experienced investment committee that's been with me for a long time, many years of experience. We are very pleased with the portfolio structure. We're pleased with how the markets and the economies are improving, and we believe, despite the fact that everyone thinks we're going to have a big correction or crash, we don't see that anywhere on the horizon. We believe that a correction is due. It's inevitable, but we think it'll be short term. We just don't know when it's going to happen. So I would encourage you to check out Nepsis Capital for our information. If you are not receiving our emails, please let us know. You are going to need to whitelist our email, and our staff has a document that shows you how to do that so that you make sure you're getting our emails. This is going to conclude our second quarterly update. We'll be back for the third quarter and have a greater update for you. Please check out the written version again, like I said, of our update. Thank you again for your confidence and the opportunity to be the steward of your resources. Again, I am Mark Pearson, President and Chief Investment Officer at Nepsis Capital Management. Make it a great day.